The deficit totals nearly $2 trillion this year. This is according to the CBO. Federal debt held by the public to 122% of GDP in 2034. Economic growth slows to 2% in 2024 this year and 1.8% in 2026 and later years.
The system is constructed such that they have to have inflation or else the system will blow up eventually. And so my belief is that it's just a matter of time until the next crisis erupts and the next inflationary event occurs.
Lawrence Lepard joins us once again. He is the managing partner at Equity Management Associates. We'll be talking about what's next for the economy and in particular, the debt crisis that just seems to be getting worse. The Congressional Budget Office just issued a stark warning for where the deficit and debt levels are going to grow. It's not pretty. This is from the CBO. So we'll talk about what's going to happen there and what's going to happen to sound money. Gold and Bitcoin are two assets that Lawrence believes are both sound money. He holds both. So we'll talk about the future of both those assets as well. Lawrence, welcome back to the show. Always good to see you.
Nice to be back with you, David. I always enjoy our conversations.
I always enjoy having you back, and the audience does too. Let's talk about, the biggest news item of the week, I believe, is the presidential debate that happened on Thursday evening. We're speaking on Friday today. You and I both watched it. What's your initial impression with, I guess, how it affects the economy going forward?
Yeah. Well, my initial impression was it was just a train wreck, just an unmitigated disaster. I mean, obviously, Biden is in no condition to be running the country or to be reelected to run the country. And, so it begs the question of who is running the country. And I can't help but wonder, to your second question of how it impacts the economy, I can't, or, the economic situation going forward, I can't help but wonder if, people, foreigners, everyone around the world, serious money people, can't see something like this and say to themselves, oh my God, these guys are really in trouble and quote unquote out of control. And, it's certainly, I mean, I thought last night, gold should have been up, $200. Bitcoin should have been heavily bid. The dollar should have been down, and people probably in other nations right now are having investment committee meetings deciding how many U.S. treasuries are going to sell if they hold any U.S. treasuries. I mean, it did not reflect well on the political leadership in this country. It is, and that's kind of an understatement.
I had this conversation with my producer, shout out to Cornelius, and he was the one who brought this up, de-dollarization being a qualitative issue, meaning,
yes.
Yeah, like you just said, a lot of world leaders, leaders in the business world, actually around the world, not wanting to invest in the U.S. going forward. It's no longer the best place to put your FDI, right, foreign direct investment. What's your take on this?
I think that's certainly right. It's certainly not a good place, storing your excess earnings, your trade surpluses in U.S. treasuries. Well, that ship has sailed. I mean, when the Treasury grabbed the Russian assets after the war started, and then as more and more countries began to deal directly with the Gulf states for purchasing oil in their own currencies. I mean, yuan, the rupee, and to some degree the ruble. All of these things are, demonstrating a trend away from the dollar, and it's not, overnight. I mean, there is, the milkshake theory still does hold to some degree, but there's a clear trend, and you see more and more countries wanting to join BRICS. I just recently read, I think 23 countries were, added to BRICS, and there are a number of more that want to join, and so this whole dollar-centric, dollar-denominated world reserve currency, the best place to store your excess earnings is in U.S. Treasuries. I mean, that narrative is going away.
It's not that I'm disagreeing with you, Lawrence, but I want to point this out to you.
Sure.
It seems like central banks are kind of reversing trend right now. This is from the Financial Times. The number of central banks seeking to increase their exposure to the U.S. dollar has increased sharply this year, according to a closely watched annual survey. A net 18% of global central banks plan to increase their allocation to the dollar over the next 1 to 2 years in response to U.S. interest rates remaining high, according to the official Monetary and Financial Institutions Forum, a UK think tank.
That's interesting. I hadn't actually seen that piece of data, and it wouldn't surprise me. Once again, the dollar is better than other fiat alternatives. But what I would also suggest is that they're also increasing their allocations to gold. And particularly China, Turkey, the Gulf states, they're all buying gold, and you can understand why. The U.S. fiscal situation is, the only way to describe it is it's an enormous mess. and getting worse. And so, the dollar is the trade expression of the U.S. income statement. The dollar is the balance sheet piece of it, and the U.S. income statement is bad and getting worse. And yes, I can see where certain countries. I mean, if we're going to have a sovereign debt crisis, there will be other countries that will fall faster and further than the dollar. I mean, the milkshake makes sense. In particular, you're seeing that right now in the yen. The yen just took out some levels, the 160 level, which had been a top for quite some period of time. And, could the yen go to 200 or 250? I mean, it probably could, which is going to create a real problem for Japan and for their inflationary situation. So, there are a lot of cross currents, and these things don't happen overnight. But I think it is a statement that's accurate that people have moved away from dollar-based holdings, particularly treasury bills or treasury securities, since 2014. And I think that trend is in place and is going to continue.
Before we continue with the interview, I want to tell you about another way you can invest your Bitcoins and store them safely instead of using a traditional wallet or an exchange. Consider an IRA. Today's sponsor, iTrust Capital, is one such IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1% only. And being an IRA, it also offers unique tax benefits. If you'd like to get started and learn more, click on itrust.capital/David in the link down below or scan the QR code up here. If you're over 18 and you want to open a new account with cash or roll over an existing account, you can do so using my referral link. And if you use that referral link, you'll get $100 in signing bonuses. Link down below or scan the QR code. What is the dollar milkshake theory for those of us who aren't familiar, Lawrence?
Yeah, it's put forward by my friend Brent Johnson, who Santiago Capital basically says that, look, the all fiat stinks, particularly compared to non-fiat gold, silver, and Bitcoin, but the dollar stinks the least because it's the world's reserve currency and people need to pay their debts in dollars. And so as a result, when you get monetary tightening and monetary problems, they surface in the smaller countries first because, and as their currencies fall, people are forced into buying the dollar because a lot of people have dollar denominated debt. The piece that I think he's missing is that, the U.S. runs a huge net negative investment position, net international investment position, and IIP. We're about 70% negative, and which means that a lot of foreigners own a lot more assets in the U.S. Than we own of foreign assets. And so while they need dollars to pay their debts, they also have dollar-based assets that they can dump. And, we saw it recently that China, for example, there was a Chinese bank that was selling U.S. Treasury securities, and we believe China is selling U.S. Treasury securities as well. So it's a lot of international kind of inside baseball on, all these relative currencies. I try to keep it simple. All of these currencies, in my opinion, stink because they're all issued by governments. They all can be printed to excess, and they all will be printed to excess. So what really matters to me is I view these currencies as against things that cannot be printed by government. And, the kind of the top of that pile is gold, silver, Bitcoin. One layer down from that is, although it can't be moved and it can be taxed, is real estate. And so, when you come to, money has lots of properties, one of which is store of value. Medium of exchange and accounting are a couple of other reasons to have money. But the store of value piece of money is always determined by the money that has the lowest stock to flow and the money that, is the most scarce. It's going to hold value the best. And, Bitcoin by math is the scarcest money in the world. Gold is second and silver is third. And all of these fiat currencies are flawed. And will ultimately, in my opinion, continue to debase against the sounder money alternatives.
Take a look at this piece of data that the Wall Street Journal put together not too long ago. There was a chart that I showed you to offline. I'll show on the screen for the audience. Nominal value and adjusted for inflation value of the household change in household net worth under Trump and under Biden. You can see that under Biden, the adjusted for inflation figure was a lot lower than the under Trump figure. Now, granted, there's 7 or 8 months left of presidency for Biden that hasn't been accounted for, but it doesn't look like it's going to catch up anytime soon. This measure is derived from Federal Reserve data. It's a measure of financial health in all assets, so including stocks, bonds, cash, property minus debts. It says here by the Wall Street Journal reported total household net worth rose 19% through Biden's first 3 years in office. not much less than the 23% through Trump's first 3 years. So
Yeah, I
the
mean,
question is how to increase wealth for Americans going forward.
well, nominally or real. So, right. And, I mean, I think most of your audience knows what that means, but, nominally, I mean, if we're inflating everything, the numbers are all going to get bigger. We're all going to be, I joked around with a friend, we're all going to be, millionaires or billionaires, but, gasoline's going to cost $100 a gallon. When you're printing money and you're increasing the number of monetary units out there and you have inflation, yeah, guess what? Your GDP goes up, your net worth goes up, everything goes up. But you really haven't, created what I consider to be true wealth, which is the real increase in GDP. And I would actually argue maybe we're in a deflationary or in somewhat of a slowdown / depression today. I don't know if we're selling as many units. And to me, real wealth is when you have more units, i.e., higher productivity, than you had before, and so you get what I consider to be real growth, and that's why in the chart you showed, you notice once you inflation adjusted, the numbers aren't nearly as impressive. And so, what's been going on is, I mean, look, as we discussed in COVID, they printed, they grew the money supply by 40%, and they also spent $2 trillion at the government level, in subsidies and so forth, and so. Those acts, pushed up. That's what pushed up the price of everything. If everybody wants to know why inflation is bad now, that's it. That's the reason why the government created a lot of monetary units and put them into the system. And so yeah. I mean, your housing price goes up, the stock market goes up. I mean, it's interesting to note the stock market is at or near record highs, although I think there's some cracks beginning to form there. And this is all because of these monetary units, increasing the number of monetary units, which is another way of saying printing money. As we know, they've been kind of trying not to do that because inflation was so hot; it ran up to 9%, and so, they began tightening with quantitative tightening, and they upped the interest rates from the zero bound up to 5.25% Fed funds rate. And those two actions have had the effect of slowing down the increase in M2, not completely because there have been other things that have added to it, but slowing down the increase in M2 and bringing inflation back down from that 9 into the 3s. But the point is that the system is constructed such that they have to have inflation or else the system will blow up eventually. And so my belief is that it's just a matter of time until the next crisis erupts and the next inflationary event occurs. And, in the last event, we saw the Fed balance sheet go from 3 trillion to 9. It's now back down to 7 because of quantitative tightening. I think in the next coming event, the balance sheet's going to go from 7 to 20. And, inflation is going to go higher. I believe we're in a decade like the 70s where we have waves of higher and higher inflation.
Yes, you're right. Inflation has held back the actual real net worth of households from climbing over the last couple of years. Let's talk about inflation now. The latest PCE, core PCE data came out just on Friday today. This is the Fed's preferred measure of inflation. And the core PCE, which strips out the cost of food and energy, rose by 0.1% in May from the prior month, in line with consensus expectations, slower than the 0.03% seen in April. And in fact, this is the slowest monthly growth rate since March 2021. What's your reaction to today's reading?
First of all, let's just consider that, I don't believe any of the government statistics, but setting that aside, let's say you did believe this. This provides the Fed with a cover they need to claim that they've got inflation going in the right direction and under control and to cut interest rates. And so even though the market is saying that they don't expect interest rate cuts until, later in the year, perhaps end of year next year, I bet the Fed's going to surprise us because I think they need to cut interest rates in order to try and reduce the U.S. federal interest expense. They need the Treasury bill costs to come down because they're financing a lot of the deficit in the short end of the curve, and the short end of the curve is expensive.
But that's the Treasury's problem, right? Why is the Fed concerned about that?
Well, because the Treasuries, yes, because they're hand in glove, the two. I mean, you're right, it is the Treasury's problem, but the Fed knows that if they understand that the U.S. government fiscal situation will come unglued if they're not able to get rates lower and bring rates lower. And so I think they will. I'm actually calling for a surprise cut sometime between now and the election. I don't think that's what the consensus view is, and I think these kinds of numbers, these kind of PCE inflation numbers, which you mentioned, are, they're awfully convenient. Are they cooked? Who knows? But there's certainly been a lot of work done by a lot of very smart people to suggest that the government, manipulates the inflation figures. I mean, John Williams at Shadow Government Stats does great work on this. So, my belief is that what they're going to do here is cut rates, and that will, hopefully allow them to pay a little bit less on the short-term borrowings and keep the economy going through the election, which is kind of, they're one of the major goals that they must have.
It's interesting how you mentioned cutting rates before the election. It could be interpreted in one of two ways. If you cut rates before the election, one, maybe the White House is putting pressure on the Fed, maybe. Or it might actually look bad for the government, because why would they cut rates if the economy is doing fine? Think about it that way, right?
Correct. That's correct. And there's a possibility they won't. I mean, I don't really know. I just have a thesis. You can see both sides of that equation. And it's possible, I would actually argue that if they're really trying to restrain the economy, the rates aren't high enough yet. But, a rate that would be high enough to truly restrain the economy, would also break a lot of things. So, we saw that last fall when the Treasury bond rates, the 10-year rate went from under 4 to over 5 very quickly. And the Fed speakers came out and jawboned it down very quickly. So, the government's in a very precarious position. The U.S. federal government's in a very precarious position at a lot of different levels. I mean, the debate showed that at the political level, that's the case. But if you actually go and look at the math on the budget, and, the CBO just came out, Congressional Budget Office just came out with a revision of their estimate for the deficit this year. And it's now 1.9 up from 1.5. That's a 27% increase. The last estimate was made in February. So we're only talking a few months. 3-4 months, and they already increased it. I think it's going to be higher than 1.9, and so this government really cannot stop spending, and that's the underlying problem that's being faced in the United States, in my opinion, and eventually is going to express itself in the debt market and then in the sound money markets. Gold, silver, Bitcoin. It already has started to express itself. I mean, even at 60,000, Bitcoin's up 50% this year. Gold just broke out of a 3-year high of 2070, and silver just broke through a 3-year high of kind of 24, 25, 26, and scored it up to 32. It's backed off that now. But the point is, I think that these sound money alternatives are all smelling what the government is about to do.
Yeah, let's talk about what the government's about to do. I like to see at the next presidential debate, somebody ask either Biden or Trump or both how to address the problem of the almost $1.1 trillion of interest payments on the federal debt annually, which is the highest in history, Lawrence, as you know, right? What are they going to do about that? What are they going to cut in order to service that debt? What's your take?
Yeah, well, that really is the problem, isn't it? I mean, that it's a debt doom loop as a result of that higher interest rate cost, and you don't see anybody talking about the consequences of it. Or you see very few people talking about the consequences of it, and the big areas to cut were Social Security, Medicare, and defense. I mean, those are the big buckets of money. There's some other discretionary things they can go after, but they can't really find, over $1 trillion in those discretionary items. So, and then there's another alternative. They could raise taxes, but that's universally, unacceptable or unpolitically acceptable, I should say, if you want to continue to be reelected. So they all, and because they're able to kind of continually kick the can, which they've done for so many years, my suspicion is that the trend will be toward we just print the money, recognizing that the cost of doing that is an inflationary event. So, there's no free lunch in economics, and if you decide you don't want to tax people and balance your budget, then you can cover it by printing money, but by doing so, you're pushing up your price level across the board. And so, we'll be looking at gas that's $6 or $7 or $8 in a few years, and hamburgers. I mean, you go to a decent restaurant and get a high-end hamburger. It's now $18, and I'm sure it'll be 25. I mean, which is ridiculous, right?
Well, you're right. Taxes are politically unpopular, but Trump wants to implement more tariffs, higher tariffs. In fact, he proposed an idea, floated this idea a while ago, not too long ago, actually, getting rid of income taxes, replacing income taxes with tariffs, which really is just another form of taxation when you think about it. But tariffs are inflationary, are they not?
They are, and they're also arguably even deflationary. I mean, it was Smoot-Hawley that made the Great Depression, which is a big tariff in the 30s that made the Great Depression even larger. Having said that, though, there's the flip side of that argument is that it might help with the process of reshoring all our manufacturing capacity, which we've sent overseas as a result of financialization during the last 30 or 40 years. So, if it would give people incentives to build things and do things here and, reemploy, our manufacturing class. So, I'm a little bit of two minds on tariffs, but, the bottom line is that the federal government has a spending problem, and there's nobody that appears to be recognizing that. And sadly, I don't think it will get addressed until there's a crisis. And at that point in time, it's unclear how it'll be addressed, but somehow it will have to be addressed. And I believe somehow we will have to go back to sound money, because I think, right now inflation's bad and a lot of people are complaining about it. But my view is, you haven't seen anything yet. It's going to get worse, rather sadly, but I think that's what's going to happen.
Let's talk about debt now. CBO's
Sure.
projection. The deficit totals nearly $2 trillion this year. This is according to the CBO. Federal debt held by the public to 122% of GDP in 2034. Economic growth slows to 2% in 2024 this year and 1.8% in 2026 and later years. They're calling for slower growth, higher debt to GDP levels, and higher deficit levels. What's going to happen?
Right, right. I've read that report and looked at it. And the amazing thing about that report is that that's kind of a best case report, because they've got assumptions in there where they say there's not going to be a recession, and inflation is going to return to 2%. And interest rates are going to come down to the 2-3% range where they were before, the whole COVID blow up. And, okay, I mean, if you really, if you really believe all three of those conditions are going to be met, and it's still not going to be very pretty, imagine what's going to happen if we have a serious downturn, if the stock market takes a serious hickey, if inflation does not calm down, and if interest rates remain at the 5% level. I mean, in my quarterly, which I'm now writing, it'll be out in a month or a few weeks. I did some just kind of playing around with the math, and if we have a downturn that looks similar to the '08 or the dot-com downturn, the deficit in the United States was going to go from 2 trillion to 4 trillion instantly. And then if they add additional programs the way they did in the COVID example, that 4 trillion could become 6 trillion. I mean, we only collect about 4.4 trillion dollars in income taxes. So if we're running a deficit that's the size of or larger than the income taxes that we collect, I mean, and we've got a real problem here, David. I mean, it's, this monetary system is really, really broken. And that's why, in my fund and on the appearances I make and the Twitter activity I'm involved with, I'm a very strong advocate for people to opt out of the fiat system and opt into, monies that can't be printed, right? Because I think that history has shown us that when a government has the power of the printing press, they will use it and use it and use it, ultimately abuse it. And, worst case scenario, we go full Weimar. I don't think that's likely. It's a tail event, but I think there's certainly we go Argentina, which is we have very, very high rates of inflation here for a while. And I think that's a likely, outcome here, given what I'm seeing on the political side.
Lawrence, you as a consumer, how do you react to this as a consumer? Do you look at the CBO's projections for higher deficit and higher debt levels and think to yourself, gee, I should probably spend less because I anticipate that the government may raise taxes more down the line in order to service this growing deficit?
No, I don't.
Does it impact your consumption pattern at all? No?
No, not really. I mean, I'm older, so I bought most of the things I need. But pretty much all I consume is food.
Okay.
And I like to eat, good food, and even if it's expensive, I still buy good food. So,
Yeah.
But I, look, it's really impacted younger people, and that's a very, very sad thing. I've got 3 kids, all in their 20s, and they all look at me and they're like, "Hey, Dad, how the hell am I ever going to buy a condominium or a house? I mean, it's, this is just upside down. I mean, I can't afford it." And that's a function of what's, how broken the system is, right?
How does this going to translate to let's talk about the assets that you're covering now, Bitcoin and gold. Let's start with Bitcoin, $60,000. You got rising deficit, rising debt levels. What does this mean for Bitcoin?
I think what's going on in Bitcoin is a slow but sure recognition by more and more people that inflation is a persistent and serious government problem, that even though the 10-year bond market says is likely to get solved, in reality, it's probably not going to get solved anytime soon. And so, people come at Bitcoin for a lot of different reasons, but or they buy Bitcoin for a lot of different reasons. But I think the largest one is the notion that here we finally have a form of money that can't be inflated. And for 2,000 years, David, or more, every form of money in the world was subject to inflation, even gold. I mean, gold goes up 1.7% a year, the supply, and over 40 years, that means the supply of gold doubles. So there's inflation in gold. Now, it's not very high compared to government inflation, which, if you look at the growth in the underlying money supply and fiat currency from 1971 to present, it compounds at like 8% roughly. So that's the monetary inflation the government has created. The gold is only compounded at 1.7%, so it's harder. The better stock to flow on gold than on fiat currency. Bitcoin, as it continues to get mined and as the halving adjustment continues to be applied in every 4 years, is now sounder than gold, and in terms of the dilution per year, and ultimately it's going to, asymptotically approach zero, so that there will only be 21 million Bitcoin in existence, and that's a huge fact. And I think as people come to see and understand that, more and more people are going to say, gee, if I want to save money, really save money for my retirement, something not for next year, I'm talking about years and years down the road, I have to save in the soundest form of money. And Bitcoin is the soundest form of money. If for some reason people are older, and I have a lot of clients like this, and they don't like Bitcoin, and they're worried about the volatility in Bitcoin, they say, what should I do? I say, well, you save in the second soundest form of money, which is gold. It's not as volatile, and it will maintain your purchasing power. Bitcoin, interestingly enough, has two things going for it. One, it's sound money, sounder than gold in terms of stock to flow. But the second thing that has really going for it is there's an adoption curve taking place. And so this is why it's performed so well in the last 15 years. And, right now we estimate maybe developed world penetration of Bitcoin might be 10%, maybe a tad less. And, using Malcolm Gladwell's tipping theory model, if it took us 15 years to get to 10%, in the next 15 years, we're going to go from 10 to 90. And that's what I see going on. I mean, you can look at the number of addresses being added. You can look at the hash rate. You can look at a lot of different measures of the soundness and the health of the Bitcoin network. And as I like to say, the dogs are eating the food, and there are more dogs coming to the party every year. And so for that reason, I think Bitcoin is going to continue to appreciate now. Admittedly with volatility. Obviously the Sam Bankman-Fried example. That whole blow up. Created an enormous opportunity for people who could, think long term, because I was paying 15,000 for Bitcoin in 2017, and when SPF and those guys blew up, it went back down to 15,000. What a buying opportunity that was.
Lawrence,
But,
sorry.
Go ahead. Yeah, no, I was just saying a lot of people think they're too late, and I disagree with that. I don't think you're too late. I mean, I think it's going to many multiples of where it is today.
Okay, what if I were to say to you, look, I'm still not convinced. I want to preserve my capital. Let's say my objective is to grow my wealth, but not over lever myself, just to preserve my wealth over time, like you said, beat inflation. I've got a lot of options. I could buy real estate, which has traditionally been good in the long run. I could put my money in CDs, collect 4 or 5% on treasuries right now. Gold we'll talk about. I don't know about this new digital asset Bitcoin. It's been volatile, like you said. It's just I don't get it. Why not just put it in this S&P where real estate, leave it alone for 30 years?
Well, I think the S&P is somewhat at risk because you're buying the S&P at the high end of the range, and as recently as the last 20 years, we've had 2 S&P drawdowns at 50%. Now, if you can live through those, fine. But if having a 50% drawdown on the S&P is going to be rough. I would say that, and I think one might be coming. I would say that if for some reason you can't find your way to buying Bitcoin, your second best choice clearly is gold. It's rarely drawn down more than 20% a year. I think once or twice it did. And it will preserve your purchasing power as it has for 5,000 years. So, and interestingly enough, I mean, I've done the math. The S&P since 71 as an example. Let's take that as a good point to start at, because that's when we went off the gold standard. The S&P 500 on a nominal basis has not beat the appreciation in gold unless you reinvest dividends tax free. And then it only beats it. It's like the difference between 8% on gold and 10% on the S&P. So, stocks have not really outperformed gold. So I think it's very clear to me that gold is your best choice. But let's go back to your initial premise. I mean, you're not comfortable with BTC, Bitcoin. I would suggest that people really owe it to themselves to do the work to become comfortable with it, because it really is going to matter. And it really is. It has been the best performing financial asset in history, the best performing financial asset for the last 15 years. And as a result of that, I have every reason to believe that pattern is going to continue. And so,
What
you know,
was
the place.
no, what was your personal process of becoming comfortable with Bitcoin? I mean, you came from a pretty traditional.
Yeah, I came from a gold guy background. Absolutely. So, yeah, I'll take you through. I'd be happy to. I mean, well, first of all, I've been a sound money guy forever, like long before Bitcoin existed. You know, I was sound money in the 2000s. I've always been kind of an Austrian economist. I mean, I could see what the Federal Reserve did with fractional reserve lending, and I watched LTCM blow up. I watched the dot-com bubble blow up. I watched, the Mexican bailouts. I mean, it's, for a long, long period of time, the government has abused the currency. And so I've always been a holder of gold, and I believed in it. The notion of a digital gold, digital currency, I was aware of all the experiments. I mean, there was hash cash, there was e-cash. There were a lot of people who tried to do it before Bitcoin. There's a good chart that shows the etymology of Bitcoin, and all these different pieces came together. And so when Bitcoin first came out in 08 or 09, I was like, yeah, they've tried that before. It doesn't work. I didn't think technically anybody could do it. And then, it kept going and it started appreciating in price, and I started paying more attention to it, and I studied how it worked. I was like, maybe they have done it. Maybe this is working. And so in 2013, I bought a little bit, and I really started studying it and going to conferences and meeting with, with the MIT Core Developers Forum and so forth. And even then, my major concern was, technically, is this thing sound? Is it going to blow up? Computers blow up, right? In the old days, used to have an IBM PC, it would go blue screen on you. And you'd reboot it. What happens when your computer blows up? You restart it. But I thought to myself, you can't restart money. If you got money and it's going to blow up, that's not going to work. So, I always had a very technical skepticism of it. But as I came to understand the technology, that went away. And comforted by the fact that we went through a lot of things, including the block wars and other things. And we got to the point where, okay, we've got 15 years of no problems and 840 odd thousand blocks have been issued. You know what? This thing's probably pretty technically sound. I mean, is it certain that it won't blow up? No, it's not. Nothing in the world is certain. We could get hit by an asteroid, but it seems to me to be pretty low probability. I mean, it's been time tested now for, quite some time. So the technical piece went away. The technical risk piece for me went away largely in my mind. The second risk piece for me in my mind is, does anybody care? Is this kind of just one of those wonky libertarian experiments that, everybody's buying this thing and, nobody gives a shit, right? Yeah, okay, you got magic internet money, but we don't care. And in the beginning, in the early days, I thought that was a pretty big risk. And what's happened is that slowly but surely, as more and more people become aware of it, more and more people care. And they look at it and they say, hey, you know what? This thing really does have the monetary properties of quote unquote kind of a digital gold. I mean, gold is the ultimate and the original form of sound money, kind of God given. And this is a digital form of gold in the sense that it's got a limited supply and it's immutable, and it's technically quite sound. So once I got to that point, I realized that this could ultimately someday supplant gold. And I mean, years and years and decades ahead from now. But in the meantime, it's going to become a right side by side with gold, a very good form of sound money. And in some ways, it's got big advantages to gold. I mean, try to send $1 billion worth of gold from point A to point B in 10 minutes. You can't do it. In fact, to try and send $1 billion of gold anywhere is quite an exercise. I mean, you need ships and planes, and it weighs $1 billion worth of gold weighs a lot. So, and yet you can do that with Bitcoin. So, and you can verify it. I mean, try to verify your gold. I mean, one of the biggest problems with gold, it was all centralized. It was in central banks. It was in bank vaults, and everybody lied about what they had. Well, with Bitcoin, it's all on a public ledger, and you can see it, and it's distributed, and everybody knows what coins are in each wallet and each address. Now, they don't know who owns the wallet, and they don't have the keys to control it, but there's transparency. It's triple entry accounting. So it's got some characteristics that I would suggest all gold people, and I gave a speech at the New Orleans Gold Show 2 or 3 years ago. It's interesting. At the beginning of that show, I asked the question. These are all older gold guys. I said, "Hey, how many of you guys own any Bitcoin?" Half the hands went up. I was surprised. And the point I was trying to make, and Brian London was very kind to let me make it, was that gold's great. I love gold. It's worked. It's taken us this far. It's going to continue to work. But Bitcoin, there's a place for Bitcoin in everybody's portfolio. Any gold holder that doesn't have Bitcoin is probably missing something, and in my opinion, needs to do the work to understand why there is a case for Bitcoin, because there is a case for it.
Why isn't central banks, especially the Eastern ones, adding gold right now, also adding Bitcoin?
Well, yes, and that's a great point. I mean, is Bitcoin ready for central bank adoption? Probably not. I mean, it's, you've got thousands of years of tradition, and you've got a 15-year-old technology, and central banks are large and extremely conservative. And so, you've got El Salvador as a central bank. They've decided to add it, but they're a very small country, and it's one case. I think you probably got a couple of other central banks that on the QT are buying it, but not talking about it. But I think it's probably not quite ready for that level of adoption yet. And by the way, that's another reason why there's going to be a place for gold. I mean, if the U.S. has a monetary crack up, which I think is some possibility of something like that occurring, I think the odds are reasonably good that the initial impulse is to reset with gold, not Bitcoin. That quote unquote Bitcoin's not ready, or we're not ready for Bitcoin. I think eventually the countries and everybody will be. I mean, to my way of seeing it, and this is probably beyond my lifetime, but to my way of seeing it, this is kind of like I see this as being very similar to the Microsoft analogy. I mean, in the early 80s when PC came out, I met Steve Ballmer, and he explained to me how this was the core base layer of running these PCs, and every house was going to have 5 PCs, and I couldn't see it. But he said it was true, and he said this company is going to be enormously huge, worth billions of dollars. And because he knew what PCs would evolve into, or he believed that what they would evolve into. And if I look at Bitcoin, I think the same thing is going to occur. I think in 30 or 40 years, the dollar is probably going to be replaced by Bitcoin. Now, 40 years is a long, long period of time. But because of its technological innovation, because of its monetary properties, I think it will probably be adopted. I mean, it's human beings tend to gravitate towards the thing that works the best. And in terms of storing value, for the past 15 years, Bitcoin has worked better than anything else. So I think that alone is going to lead more and more people. The adoption is going to continue, I guess, is the point I'm trying to make.
Let's talk about gold to finish up here. What's next for gold? The interest rate has been high still. The real interest rates are actually going up. The dollar remains strong. Inflation is coming down. All these factors are supposedly headwinds for gold, and yet here we are. You're $2,400, near all-time highs, highest level in history.
It's a great point, David. And I think what's going on here, gold is really good at sniffing around the corners, looking around the corners. I mean, I think what gold, we all look at the monetary situation, and I say we, those of us who are Austrian in background, look at the monetary situation, say this is messed up and it can't continue. And the gold market, I think, is kind of a good measure of kind of the Austrian economic views. And I think what the gold market smells is that they are going to have to print a lot more money at some point in the future. And the market's saying, you know what, I want to get in front of that, even though they haven't started that printing process yet. I mean, it's interesting. I mean, we couldn't foresee COVID coming, and yet, and gold was kind of trapped below 1365 in 2019. And yet we had the repo blowout that year, and gold went from that 1365 up to 18 or 1900 before the repo blowout. And so, again, gold kind of sniffed out the future inflation. I think that's what's going on. My belief is we'll probably end the year at 3,000 gold plus or minus. And the thing I think it's important to understand is just how asymmetric gold is, how little gold there is in the world, and how much fiat paper there is in the world. I mean, there have been great studies that have shown if you go back into the 70s and you look at the amount of the money supply in the United States, you divide it by the 261 million ounces that the U.S. owned, you could get close to the reference price of $35 an ounce. If you did that same math today, all the money outstanding divided by the ounces we own, gold would need to be $80,000 an ounce, and it's at 2,300. Now, I'm not suggesting we're going to go to that anything close to that number, but what I am suggesting is that the suppression of the price and the ignoring of gold by most investors for the past 10, 15 years, because in a deflationary world you didn't feel like you needed it, I think that's set to violently revert in the other direction, because I don't think we live. We had deflation from the early 80s all the way into 2020, and I think that changed. We hit peak deflation in March of 2020 with the COVID crisis, and now I think we live in an inflationary world. And if that's the case, then gold and silver are going to be multiples higher of where they are today in 5 years or 10 years, and Bitcoin will be too. So, I remember very clearly, it was interesting in the early 80s when I was in this business. At the time, stocks were a terrible thing to invest in. You wanted to own gold, you wanted to own commodities, you wanted to own inflation protection. I'm talking about 82, 3, 4 time frame. And the reason for that is because you just come through the inflationary 70s, and the only people who had made money in the 70s were people who invested in inflation, in the inflation trade. So everyone tended to look backward in 82, 3, 4, right? Well, we've just had an enormous period of deflation, and everyone who's made money has made it in stocks and bonds. And yet, the trend clearly is reversed, in my opinion. But people are still thinking we're going to go back to low inflation, deflationary world, and you don't need inflation protection. And my belief is the polar opposite of that. And by the way, in 82 or 83, that was a great period to buy stocks. You were just about to start a 40-year bull market in stocks. So, I don't know that this one's going to last 40 years, but I think this inflationary commodity cycle has easily got 5 to 10 years to run. And then perhaps we reset the currency because we've got too high inflation and the problems have become so obvious. So with that in mind, to me, it's very early days for investing in gold, silver, Bitcoin, and gold and silver mining companies, which is what the fund I manage does. We pick gold and silver mining companies. So
I can't help but notice that the last low point for gold was 1822 on October 6th. The day after, when war broke out in Gaza, it started spiking, and it hasn't really stopped spiking since the 6 months, 7, 8 month bull run now. The bear case for gold, actually, for me, would be a de-escalation of global conflict, and then the geopolitical risk comes back down. What do you think?
I think that's right. I think that's a piece of it, and the geopolitical risk is a piece of what's made gold go up. But I think the bigger piece is the monetary, behavior of the United States. And the thing I tell people who are considering investing in my fund, they say, if they're smart, they ask me, say, well, what could go wrong, Larry? How does this not work? Because we all know there's risk in any investment. And my answer is always, I'll tell you how this goes wrong. And of course, they laugh at this answer because the odds are low. But the answer is, the U.S. government, the U.S. federal government gets incredibly responsible. We decide that we've got to cut back Social Security, we've got to cut back Medicare, we've got to means test them, we've got to raise taxes across the board, particularly on the very rich, and we've got to, pass a balanced budget amendment and actually make our budget balance so that we stop this growth in debt and deficits, and we get back to a point where the economy can grow on its own without more debt. And eventually we'll get back to a more balanced, system, very much the way we worked off the excess debt that we occurred in World War II. I mean, I think that's to me what will make, the thesis behind all these sound money things not work. Now, will the U.S. do that? Maybe, and probably eventually when things get bad enough, inflation-wise, we probably will do that. But right now, I don't see any evidence of the U.S. behaving in that fashion, right? I mean, every time you turn around, there's a new program. There's the Inflation Reduction. I mean, and there's these things have Orwellian terms. I mean, we're going to spend money in the Inflation Reduction Act. Oh, really? I mean, you can't make this shit up, right? I mean, I read this morning that Yellen is just putting forth some program of hundreds of millions of dollars to help with affordable housing. Oh, okay. Good idea. Create more inflation so we can have affordable housing.
Did you see that news item? They're building shelters for the homeless in LA, and each unit apparently costs $600,000.
I did not see that, but it doesn't surprise me. It's absolutely nuts, David, what they're doing in all areas. I mean, think of all the money we've spent in the Ukraine. I mean, think of all the money we raised. Imagine if all the money we used in the wars in the Middle East from 2000 onward, the $6 trillion. Imagine if that had been spent on infrastructure and cheaper energy and, things that would actually benefit, the productivity and population of the United States, instead of, just being pissed away in, overseas wars that really accomplish nothing. It's tragic. It's absolutely tragic. And that's, to me, that's a function of the military industrial complex, having the government, in a stranglehold and being able to dictate what we do.
Perhaps they're doing that to bolster the strength of the dollar. Right, going back.
Well, that's right too. I mean, the strength of the dollar, there's no doubt. I mean, people say the dollar is backed by the strongest military in the world, and there is no doubt we do have the strongest military in the world. But even that's starting to fray at the edges. I mean, there's some great studies that showed how, a lot of what we need comes from China, and we've offshored so much of our military, of our manufacturing capability, that if we were to get into a war with China, we'd be screwed because some of the things that we need, in the munitions area, we get the pieces from China. So, it's we've really painted ourselves into a dark corner here, and it's going to take some doing for those of us who are in the sound money world to get this thing fixed. But we will. I mean, I'm very optimistic about, my kids' future once we make it through this next 10 years of kind of transition.
All right. Well, where we can learn more about you and Sound Money, Lawrence?
Yeah, so I'm on Twitter making a ton of noise, criticizing the central bankers who I think are just completely out to lunch, at Lawrence Lepard. And then it might have a website, EMA2, Edward Mark Alpha, the number 2.com. And my partner and I, David Foley, we write a quarterly newsletter that talks about the macro conditions, and all of these things really that we've been talking about, investing in sound money, the irresponsibility of the government, et cetera. And that newsletter is free. It's done quarterly. You can sign up by putting your email into the system, and we'll never spam you. But I would just say in closing that, everybody who is looking at their investment situation, and, a lot of people have a 60-40 portfolio, bonds and stocks, and kind of the traditional things that your broker will put you into. And I would just say, if you don't have something that's some portion of your wealth and your savings allocated towards things that represent quote unquote sound money, I think your outlook is going to be less than optimal in the next 10 years, because I think we have an inflationary 10 years coming.
Lawrence, great talk with you, as always.
Likewise, David. Yeah.
Speak again soon, and we'll put the links down below so people can follow you. Speak next time.
Okay, sounds great, David. Thank you. Take care.
Thank you for watching. Don't forget to like and subscribe and follow Lawrence. The links down below.